If your organization is ready to embrace edge computing, we have good news. The 2023 AT&T Cybersecurity Insights Report provides everything you need to know to get started. In the report, we identify the common characteristics of edge computing. We found edge use cases are rapidly coming online, and we reveal how to secure edge computing. Most importantly, you'll learn how to prepare for your edge ecosystem. Get your complimentary copy of the report today. Visit securityweekly.com/ATT cybersecurity. That's securityweekly.com/ATT cybersecurity. Welcome back to Enterprise Security Weekly. Security Weekly listeners, we are celebrating the milestone of reaching over 1,000 members of our CISO community. The Cybersecurity Collaboration Forum is a one-stop shop for executive collaboration comprised of CISOs across various industries. If you want to be part of this growing community of CISOs, join us as a member or technology partner. To learn more, visit securityweekly.com/cybersecurity collaboration. All right, and for our second interview, Chad Cardenas joins us today to talk about alternative approaches to startup funding. He's the CEO and founder of the Syndicate Group, or TSG. Chad previously co-founded Trace3, where he served as president and chief innovation officer, studying macro trends in the IT industry and their effects on the VC startup channel, CXO, and investor communities. Welcome to the show, Chad.
Thank you. Thanks for having me.
Yeah, absolutely. This is, it's interesting. This is one of our favorite topics, I think, to dive into. If you've ever watched one of our news segments, we love to dive into the market. Myself, Katie, and Tyler have all been industry analysts, so perhaps that's part of it. Tyler is also an angel investor, so I wanted to make sure and have him on here. And actually, Tyler, you weren't on the last segment, so I should welcome you. How are you doing?
Oh, thank you, my friend. I appreciate that, Adrian. Yeah, good to see you. And Chad, good to see you as well. I've definitely seen your name floating around in circles, so good to meet you, my friend.
Likewise, great to meet you.
All right, so let's get started with some of the story behind TSG, because, and from here on out, I'll just say TSG just to simplify it. Looks like that's what you do in a lot of your materials as well. But very, very much a non-standard approach to investment from what we've seen from. We've seen more and more creative stuff over the last 5 years or so, but this one still seems fairly unique. So want to kind of understand the story behind it. Why go this route and not a traditional VC route with LPs?
Yeah, it is. It's definitely non-traditional. Still relatively foreign concept, I think, among some circles within the industry. But it started with, and I'm going to make certain assumptions about the audience's familiarity with the industry, but just if there's anything that I need to go into in more detail or clarify, please, let me know. I'm happy to, of course. But my last business that you mentioned, Trace3, was a very successful VAR integration business, what's commonly referred to as a channel company. And we had a very intense focus on emerging tech. We basically believed that if we could be at least early to market, maybe in some cases first to market with the next great enterprise tech product and company, it would set us apart from a lot of the competition. And so we built a lot of internal programs around that, an innovation team, a research team. We built relationships in Silicon Valley with the entrepreneur communities and the venture community. And that model worked for us as a channel business. But for me, it exposed what I thought were a couple key gaps in the industry. In particular, very highly strategic individuals and entities within a startup's ecosystem were largely left out of the investment side of that relationship. And I just thought if the right model was created to where those entities, those individuals were helping a company, a startup get to market by selling the product, marketing the product, or even some of the individuals that were helping the company grow by buying the product, if they could be given access to invest in those companies, then everybody would win. So long story short, we started tinkering with that model when I was still at Trace3. I put together special purpose vehicles We'd take a small allocation in a round of funding alongside the lead VCs. And then we would fill that allocation with myself and my peers in the business with our own personal capital. We did that with companies like Nutanix, AppDynamics, Cohesity, CrowdStrike was a big one. And everybody celebrated that model because it worked so well on a relatively small scale. So when we had a private equity event with Trace3 in 2017, I left to start TSG to build out that model at scale as a standalone business and outside the confines of any one, channel company. So we're essentially a venture firm that does not, by design, invest out of a fund, but instead we have hundreds of channel businesses, thousands of individuals that work for those companies, and dozens of CXOs and CISOs that make up our investor base, and we bring them to bear when we're working with a company.
So I'll probably let Tyler jump in here in a moment, but before we get there, help me out with, so Tyler's been my educator on a lot of the terminology from the investment world, the stuff that I didn't pick up from when I was an industry analyst, but so SPVs, yeah, I know what SPACs are, but help me out with that term.
Yeah, so very high level, in venture terms. So most big name, brand name venture firms that you're familiar with, they raise a fund. Capital comes from places like university endowments, pension funds, multi-billion-dollar family offices. These are, it's tens, hundreds, maybe even billions of dollars. And then they invest out of that fund into a number of different startups. A special purpose vehicle is basically, it's a separate standalone entity. So we form a new LLC company for every investment that we make. And then that entity becomes the investing entity on the cap table of the startup. And so it's a single investment entity that arrives on the cap table of the startup, but then within that entity could be dozens and dozens of individuals that actually contributed the capital to the entity.
Got it. Thank you. That perfect explanation. I'm with you now.
Yeah, and so the main things, like in terms of why people invest this way, it's a way to organize a large number of relatively small, from a capital perspective, small investors, organize them all together into a single vehicle. And then for the startups, it's a way for them to get all the strategic value of all those smaller investors, but without the cap table complexities of having them all directly as investors in the business.
Gotcha. Yeah, so this is a really interesting model for sure. It's not something I've heard of before, where you're, for lack of a better term, I'll use the term LP. And for the audience that don't know what that is, that's a limiting partner or a limited partner. That's the people that are putting money into the SPVs. But your LPs are all channel resellers across the board uniformly, or do you kind of branch beyond that occasionally?
We branch beyond that occasionally. So we do have a lot of corporate technology executives, so CXOs, CISOs. That's probably the fastest growing portion of our investor base. And then we have some non-strategic investors that are not in either of those categories, and they just provide capital. That's a small percentage of our investors, but that helps us when we have an outsized allocation, and then with the permission of the startup, we can actually bring those folks in to just fill the allocation and close quickly.
Yeah, what I really dig about the model, Chad, quite frankly, is that it's in alignment, meaning the incentive structure for the limited partners, in this case, the channel sales teams, is they control their own destiny, right? They pick a horse. They say, hey, FD, Nutanix, whichever one it is, we believe that's the one that's going to dominate that market. We're going to get behind it, and we're going to resell that one specifically so they can provide their own fuel to the fire, right? Is that kind of the thought process behind in aligning the incentives between the different parties?
That's exactly it. That's really at the core of everything that we do, is aligning those incentives and goals and really driving behavior accordingly. It makes a difference when you have the ability to represent multiple different products in a given space within the industry. and you've made a decision based on your research, vetting the companies and everything. You've made a decision on one being the best and having the best long-term viability, so much so that you're willing to invest your own personal capital into that business. It really does drive behavior. And I'm sure we'll get into it, but there are examples of that on the early end of the spectrum with these startups, and then even on the more mature side, where these companies leverage the program to really capture that mind share and focus of their strategic ecosystem all the way through exit.
So how big are the LPs, the channel sales teams that are doing the investing, or the founders of the channel sales teams that are doing the investing? Do they range from, because channel sales can go down to MSP, MSSP levels, right? VAR levels that are very regional, very micro specific, all the way up through, your Optives and your Guide Points of the world, the big players, right? So do you go down market with the LP base, or do you kind of find a sweet spot where it's like here or larger tends to fit well?
Yeah, great question. Both. So we have those names that you mentioned and a lot of others in that category, very active in our network. And then we go all the way down to what I would refer to as more boutique and truly regional partners, like a security focused reseller integrator in New York or in the Southeast, like very small companies that a lot of folks have never heard of, but are very influential and powerful within their smaller kind of metro ecosystem, and they have great client relationships. So from that lower end all the way up to a couple of the names that you mentioned and others that are, $10-20 billion businesses.
So I'm going to shift gears a little bit and stop asking about the model, because I think it's pretty clear that the alignment of incentives is fantastic and it's giving you a force multiplier for the sales of those companies. Let me ask, actually, before I leave it, let me ask one more follow-on question. With the deals that you invest in, what stages are you looking for, right? So for the audience that don't understand venture capital, usually venture capital is raised and targeting a specific stage, seed, A, B, C, et cetera, growth funds, late stage, all different kinds of stages. And you raise those funds ahead of time saying, we're going to invest in, round B plus or B and C or late stage or whatever it is. And the LPs are committed to a certain space. How early do you find it fits well for the channel to back a company? So I've helped build a couple of companies in the past, and what I've found is there's kind of a sweet spot somewhere around, I don't know, let's call it 15 million of ARR, where the channel starts to get excited. They start to say, hey, there's traction here. We can add value. We can bring this to market alongside you, et cetera. At what point do you think it makes sense to take in equity from a channel-backed model like you do? Is it pre-seed? Is it BC? Or is it late stage that fits best?
Yeah, great points. It's typically from like maybe a mature A round, but really kind of like a series B and beyond. And to your point about, the channel in general getting excited about a company when they're 15 million in revenue and beyond, I think that's true. I think it's especially historically true, but it's shifting earlier. And we like to think that we are, with our program, we are encouraging that shift to much earlier on. So if we were having this conversation, I don't know, 15 years ago, 20 years ago, a lot of enterprise tech companies at that time, they kind of had a decision to make, do we have a more direct model, or do we go through channels, build these relationships? And some of them did and some of them didn't. Today, I feel like any company on the B2B side of the industry that has a product or an offering that can in any way, shape, or form be sold and marketed through indirect sales, through a channel, if they don't do that, then they will be left behind. So it's way more common now for companies to realize earlier in their growth that they have to start building a healthy channel ecosystem. So for us, that means really like from 1 million to 5 million in ARR. So we don't do any pre-seed or seed investing. The company has to have at least the beginnings of a go-to-market strategy, the beginnings of revenue, and the beginnings of like maybe their first couple channel partners. And then we come in and we help them accelerate that and launch it.
Yeah, and that's a huge problem, right? So having built up a couple of companies that got to the stage where we started to engage with channel partners, that's a difficult task. Typically, companies have to hire, at least one, if not two or three experts around building the channel to be able to be successful, to get the mind share. There's thousands, right? 3,000 plus, I believe the number is, competing cyber products. If we just stay in the cyber market only, we already recognize that you have, as a channel, you have to pick from thousands and thousands of products about which ones you're going to back and which ones you're going to sell to your customers. So, that I think that acceleration and expertise that you can bring to a late A, early B stage company really would help them from a process perspective, where many times they've been selling direct to that point. Does that fit kind of the model?
Excuse me, it's so true. The number of companies, pick any, you're right about cyber too, like any subcategory of cyber, and there's half a dozen or a dozen companies that kind of all maybe sound the same or are trying to solve the same problem with the same sounding solutions. Very difficult to distinguish among those companies. And by the way, to further complicate things, the channel industry is very crowded, and it can be very difficult if you don't know what you're doing. Very difficult to select the right partners at the right stage in your business. I always joke about how, and it's really not a joke, it's reality, how there are infinitely more ways to screw up a channel strategy or the execution of a channel strategy than there are to get it right. And so, yes, we see companies struggle with that all the time, and there's a real cost associated with getting it wrong and then having to revert back and start over.
Yeah, it's interesting. I don't know how much of understanding how SPVs work that our audience has, and so we did have one question come in from the Discord asking specifically about whether your investors have influence on the investment targets. I'll let you explain how that works in the SPV world.
Yeah, so for us, we have, if I understand the question correctly, they do have, the way I understand the question is, do our investors have influence over which companies we decide to invest in? And if I'm getting that right, then
yeah, so that is absolutely the question. And I know you're going to dig into what an SPV means to answer that question, I presume.
Yes. So, and different SPV type of investing firms may do this differently. Like, this may not always be the case with all SPV investing, but for us, it's a big part of what we do, because our investors, by and large, they're not professional investors investing in tech to make money. First and foremost, they are industry aware, they're industry savvy, and they're operators really in the industry. And so they know the technology, they know the space, the competitive landscape, the industry. And so it's a big part of our diligence process and our selection process to actually take that input from our network of investors. It's a community of thousands of individuals that are living and breathing these technology problems and solutions on behalf of their clients every day. And so we have an online portal. We have a platform that we've built over the course of several years, and we've created a mechanism in there for folks to give real-time feedback on the companies that we are considering investing in. And if there's not a company listed in our platform, they can suggest one for us to take a look at, which we always wind up doing. And so, yes, short answer, yes. And that's a big difference between this type of investing and being a true LP or limited partner in a venture fund, where you're just, in that scenario, you're just committing capital up front, and the firm is making all of the decisions as to where that capital gets deployed.
Yeah. And for those that don't know, so I've run SPVs out of 90 Degree Ventures, my firm that I work with, and essentially the way that usually works is you pick an investment, you build up and get an allocation, and you fulfill that allocation by bringing in the investors to fulfill on the SPV. And in general, the way that most of those works, most of the SPVs in that model work is it's optional, right? You'll have a list of 1,000 potential investors, and you'll put it out there and say who wants in. They commit a chunk of capital, the investment gets fulfilled, and you move forward. So is that a similar approach, or do you say, hey, 1,000 investors, you're committed to X amount a year, or is this kind of they get to pick and choose where they want to back?
Yeah, it's the latter. They get to pick and choose, and that is probably one of the more celebrated aspects of our platform and this investment model. Being an LP in a big fund is great for somebody who's maybe not super interested in the actual technology or businesses that are being invested in, and they're just looking to park a lot of capital and get some sort of returns. But this model, and it sounds like the one that you're representing with 90 Degree, I think it really favors folks that are more industry aware and want to evaluate individual deals on a deal by deal basis and opt in or opt out of each deal accordingly. And then if you have the right makeup of whatever members, if you will, within that ecosystem, it can be an incredibly powerful source of data in terms of selecting the right companies.
Yep, totally agree. So, follow-on question: do you have any investment theses specifically with regards to the technologies that you're excited about right now, with different markets that you're saying, hey, we think these ones are going to be explosive growth? At the end of the day, you are the face of a syndicated group of folks in the channel that have their own intelligence about the market. They know what they believe in, but obviously you're seeing deal after deal after deal, and deal flow is your specialty. So where do you think the future is? Where are the biggest seed and pre-seed and kind of growth markets today in cyber?
I think, well, I'll start with what I think has been a little bit overlooked in recent months or years with the onset of AI and the resulting hype behind that. And we'll talk about that specifically too, but we've always been focused on just enterprise tech, so all B2B. So if you look at a big venture firm's portfolio, a lot of times it's segmented between enterprise and consumer. We don't do anything on the consumer side, all enterprise. So that's cloud, cybersecurity, next gen infrastructure, things like, compute, data management, data storage, networking. And so I think it's important to remind folks that, the, whatever you call it, maybe the global 2000 of corporations that are building, they have these massive businesses, and then they have these tremendous data centers all over the world to run these businesses. Those companies still have increasing demand for what today is considered, I guess, kind of traditional infrastructure. So everything, all the software and hardware that would go into a data center like that, there's a ton of innovation in that space ongoing. It has not let up. It's only increased in terms of its speed. And so that will remain a focus for us. If I just had to pick one kind of category off the top of my head, I would say maybe application security. So SaaS, security seems to be a very, very in demand area right now for these companies. And so there's a lot of capital flowing into companies that are presenting solutions there. We could get into cyber in general. I mean, that seems to be kind of the way of the world. I feel like cybersecurity right now is kind of, if you remember back in the mainframe computing days, and then all of the individual components of mainframe computing were broken out and built into entire, products and industries, like even things like Cisco with the router. I feel like that's happening now and has been with cybersecurity. Like we didn't have, I think you're familiar with the API security space.
I am.
We didn't have things like that before. We had more general solutions, and now we have very specific point products, point technologies to solve a very specific, threat or vulnerability with APIs or shadow SaaS apps or whatever it may be. So there's a lot of opportunity there. And then, of course, artificial intelligence. We are not we are not focused on AI as a pure play investment, meaning we're not investing in pure AI companies, but we are investing in a lot of companies that are in that enterprise infrastructure space or cybersecurity that are leveraging AI technology to make their products and offerings better.
Mm-hmm. Yeah, nope, totally get that. I think that's a very astute view. To invest in raw AI is a very vague investment. To invest in applied AI is a very intelligent investment. I've been thinking and putting my own thesis cap on quite frequently around consolidation in the market. And I actually wrote a piece just last night. Wrote a little paragraph or two on if we had hit. If VC is in a bull or a bear state right now, in particular, let's scope this question down to, is cyber investing in a bull or a bear state? And the follow-on point to this is, given the 10,000 plus products, 3,000 plus companies in market today, is there room for more? Is there room for more unique siloed innovation that will be bought even though we're in a bit of a recessionary market? Or does the CISO's balance sheet recession cause massive acquisition, massive M&A, massive roll-up by platform players such as Palo Alto, et cetera? And the short near-term view is that we're going to see consolidation before we see continued investment. I'd love to hear your opinion on where you think we are with regards to cybersecurity investment today, and whether the near-term future is all about M&A and roll-up, or whether now is a good time to be putting capital to work.
It's so interesting because it's actually, in my opinion, it's a little of both. Like M&A and roll-up will I think be a big thing for the foreseeable future. But I hesitate to generalize across the whole industry, because if you just look at the last, let's say 2 years, IPO market's basically frozen. The funding climate very dampened. It's been very, very difficult for a lot of startups that 3 years ago would have had no problem getting funding. Now they're struggling. Venture firms struggling accordingly, and a lot of them, quite frankly, will just not make the turn. They won't make it out of this alive. And so it's been, not to sugarcoat it, it's been a grim 18 months or 2 years, and that may continue for another few months, but not for everybody. So we have the luxury of not investing out of a big $1 billion fund into dozens and dozens of companies and having to make bets that maybe will work out, maybe will not work out. Instead, we're only looking at 5 or 6 companies a year to partner with, invest in, and run our program for. And so we work with companies that are kind of at the top of the heap all the time. And so while it's been bad times for a lot of firms and a lot of startups, there are still really, really great startups out there that are growing revenue, hiring, taking market share. Companies like Abnormal Security or Vast Data or Cohesity, these are very, very solid businesses that are continuing to grow, continue to raise capital. And so I think, to answer your question, it really is a little of both. And it just kind of depends on where you are on that spectrum of quality of business and positioning for the future. I don't think we need more startups in each subcategory of cybersecurity. I think that's been part of the problem for the last several years. We don't need, I think to a point you want competition, but we don't need 6 or 7 or 8 API security companies, because what that does is it muddies the waters, if you will, for everybody, for the folks looking to fund these businesses, for the channel companies trying to figure out which ones to partner with and bring to market, and certainly for CIOs and CISOs that are trying to sort through the chaos and the noise of the industry and figure out which one of these companies will be around in 5, 6, 7 years, and which one has the best technology to meet the needs of my business. And so what that does is when you have too crowded of a market, it makes it more difficult for the truly great companies to rise up. And it just, sucks a lot of capital out of the market. So I don't know. I think
if I can just interject, particularly when half of those companies are pretending that they're completely unique and not competing with other companies that they're clearly competing with. Like it's almost confusing the market is almost a marketing strategy at this point.
It's crazy. That's such a great point. Like I talk to founder CEOs all the time, and one of the first questions I ask them is, who do you view as your competitors in 2 different categories? Like larger incumbent, big businesses that have been around for a long time, and then any startups that are kind of, just getting started and may be competing with you, or you might compete with in the future. And it's amazing to me how often the answer to that question is, well, nobody's really doing what we're doing. We're not, like, nobody's really competing directly with us, because that's more often not the case. So yeah, it's an interesting time because it's difficult, very difficult time for, I would say, the average or below average startup that years ago took advantage of just this free flow of capital, and now that spigot has been turned off. But it's still a great time for the truly, like, the top, whatever, 1 or 2 or 3% of these startups. So I guess in times like this, it pays to be a winner.
Right. And it's I suppose it's somewhat of an advantage, the fact that you're later in the cycle. B and C, like already some of those companies have been, we see quite a few get acquired, even pre-Series A these days, or they just don't even make it past that point. They don't raise that Series B, and they don't quite make it that far. So I wonder if that's one of the advantages that you see is, because your post revenue, or maybe that's the reason you've done it, is to kind of filter those out that aren't going to find a market fit and are never going to have significant revenue.
So I'm gonna jump in the middle of your answer, Chad, and I'm gonna say one thing. 100%, Adrian, you're absolutely spot on. And the best part about that comment is, unlike a traditional fund that has to take in, or that takes in hundreds of millions, if not billions of dollars, and has to deploy this capital into an operating venture, the best thing and the cool thing about a syndicate model, which is what the Syndicate Group is in this SPV approach, is they don't have to put capital to work. There's no demand that says we've taken in $1 billion and it has to be put to work in the next 3 years. They get to put
not
it to
forced to
work
make bad
when
deals.
the company is right, and when the vision is right, and when the market is right, and when the investors want to be involved. Is that right, Chad?
I couldn't have put it better myself. So I don't mind you jumping in. It's absolutely right. Yeah.
All right.
If
you want to expand on that.
It's a luxury. And, to be clear, there are trade-offs, right? Like, the later you invest, typically the trade-off is, so you get the added security of risk mitigation, if you will, on these investments, but you're also by definition going to have a lower average return or multiple on these investments. But if you do it right, you can hit a sweet spot and have a much higher success rate in terms of companies that return a profitable exit. And in our case, maybe it's the same with 90 Degree. It's like the inverse of a traditional VC model in terms of percentage of companies that return a profit. We're just, we're not chasing the 50, 60, 70x, the 1 out of 20 that's going to return, the rest.
That's right.
Right. Yeah. So from here, I kind of wanted to, pardon the pun, but pivot into talking about the state of the current market. We followed really closely, and it's interesting coincidence right now that we actually have I think this is our very first security unicorn since June 2021, if I'm remembering correctly. We're going to talk about Island raising 100 million and getting a 1.5 billion valuation, which, unless I've missed something, there might be one company I've missed, but it is starting to look like things are coming back. And, we're hearing rumors about IPOs. So want to kind of get your thoughts on the market generally there. When we've had other investors on, they shoulders were shrugged, hands were thrown up. I think it was really difficult to call middle of last year, early this year. But are we getting closer to being able to see the light at the end of the tunnel?
I think so. I hope so. Yeah, I saw that Island raise, and that was encouraging. By the way, just another example of like companies that are on the right track and doing well, have no problem raising a big round at a big valuation, even in this environment. So yeah, just quick thoughts on what's next in terms of the IPO market and the industry in general. I think if you look back in history, I think going back 20 or 30 years, the last two times we've had this big of a slowdown in terms of like funding IPOs in particular, when we had like a virtual freeze on IPOs for more than a year. I think the first one was in 01, 02. Was it 2000, 2001 or 01, 02? And then again in 08, 09. Each time it didn't last more than, I think, 18 months, maybe 2 years at the most. And then the demand just caught up to it. And I think and hope that that's the case here. I mean, we're basically going on 2 years now, maybe not quite, not quite 2 years of no IPOs or virtually no IPOs. And I think the demand is coming back. We saw a couple of weeks ago, what were those? The chip manufacturer and I think it's Instacart. There's a lot of, those were hotly anticipated. They started off strong and then kind of came back down to original or below level. So it wasn't a great performance, but there are a lot of companies that are ready and there's demand, I believe, in the public markets for these companies. We have a few in our portfolio right now, probably 20% of the portfolio is ready, but a great example would be Cohesity. They filed their S1 in December of 21 for a planned IPO in the spring of 22, which is right when everything took a turn for the worse. And so they've been on hold ever since, but they're continuing to grow and become stronger, bigger as a business, and even more ready for an IPO. So I think companies like that, they will weather this storm and they'll come out of this ahead. So yes, I think by spring of next year, I'm not big on predictions, but I do believe by second quarter of next year, if not sooner, we'll start to see the tech IPO market loosening up, along with funding and raising for a lot of these startups.
And it's interesting, we didn't see it happen all at once. We actually had a graph where we showed both the security IPOs, which we steadily had, or not IPOs, sorry, unicorns. We steadily saw 2 to 3 new unicorns made every month. And that dropped off about a month or two after we saw the layoffs start. And I think really, I think it was OneTrust, I believe that's right, that laid off 1,000 people. That was really kind of the big indicator that there was trouble brewing there. So yeah, I think your other parts of the market took a little bit longer to feel the impact, but if anything, it's a little bit over 2 years. So it's it's good to see signs that it's going back.
Yeah, we'll see. I do, I have some concerns about next year being an election year, and there's obviously a lot of, global, political stuff happening, conflicts and everything. But from a timing perspective and just pure demand, in the industry and in the markets, I think it's there, and we should be coming out of it next year.
All right. Sounds good. Tyler, do you have anything else before we wrap here?
No, it's great to get the time to chat with another investor and another person that runs a syndicate. It's super impressive that what you're working on here and what you've built. And I really love the alignment in incentives. I think that's just such a cool concept and cool model versus the traditional syndicate model. Man, it's such a unique approach.
Thank you. I appreciate that. It makes it fun. It definitely makes it fun.
Yep. So no other questions for me, Adrian.
Okay. Yeah, Chad, thank you so much for joining us on Enterprise Security Weekly today. It's been an awesome conversation, and I appreciate you taking the time.
Thanks, guys. I appreciate you having me.
All right, and we'll be right back in a few moments with the weekly Enterprise News.